Welcome to Factor Online channel, where we talk about personal finance education. How to roll over 401k to self-directed IRA. What is a self-directed individual retirement account or SDIRA? A self-directed individual retirement account is an IRA that can hold a variety of alternative investments that are generally restricted in traditional IRAs. Despite the fact that the account is controlled by a custodian or trustee, it is managed directly by the account holder, which is why it is referred to as self-directed. Self-directed IRAs are best suited for savvy investors who already understand alternative investments and want to diversify in a tax-advantaged account. They are available as either a traditional IRA, to which you make tax-deductible contributions, or a Roth IRA, from which you take tax-free distributions. A self-directed IRA is a type of IRA that differs from standard and Roth IRAs. In self-directed IRAs, you can hold a number of alternative investments, including real estate, that you couldn't in traditional IRAs. Self-directed IRAs are often offered exclusively through specialized organizations that provide SDIRA custodial services. SDIRA custodians are unable to provide financial or investment advice, so the account holder is responsible for all research, due diligence, and asset management. SDIRAs come with additional risks, including fees and the chance of fraud. A self-directed IRA is a type of IRA that allows you to choose how you want to invest your money. The sorts of investments that can be held in an SDIRA differ from those that can be held in ordinary IRAs. Regular IRAs are restricted to common securities such as stocks, bonds, certificates of deposit, and mutual or exchange-traded funds in general. SDIRAs, on the other hand, allow the owner to invest in a considerably wider range of assets. Precious metals, commodities, private placements, limited partnerships, tax lien certificates, real estate, and other alternative assets can all be held in an SDIRA. As a result, an SDIRA necessitates more initiative and due diligence on the part of the account owner. How to get started with an SDIRA? You can only open a standard IRA, traditional or Roth, with most IRA providers, and you can only invest in the usual options, equities, bonds, and mutual funds or ETFs. You'll need a qualified IRA custodian that specializes in that type of account to start a self-directed IRA. Not every SDIRA custodian has the same investing options. If you're looking for a specific asset, such as gold bullion, check sure it's available from a potential custodian. Because SDIRAs are self-directed, custodians are not permitted to provide financial advice. As a result, traditional brokerages, banks, and financial firms rarely provide them to their customers. That implies you must complete your homework independently. If you require assistance in selecting or managing your investments, you should consult a financial counselor. A list of IRS qualified account custodians can be found on the website Self-Directed IRA. What's the difference between traditional self-directed IRA and a Roth self-directed IRA? Traditional IRAs and Roth IRAs are both options for self-directed IRAs. However, keep in mind that the tax treatment, eligibility conditions, contribution restrictions, and payout rules for the two account types are all different. When you pay taxes on a standard IRA versus a Roth IRA, there is a significant difference. Traditional IRAs provide a tax credit up front, but you must pay taxes on your contributions and gains when you withdraw them during retirement. Contributing to a Roth IRA, on the other hand, does not result in a tax break. However, your contributions and earnings increase tax-free, as do eligible distributions. There are, of course, other distinctions to consider. Here's a quick rundown of what's going on. Income restrictions apply. Traditional IRAs have no income limits, but you must earn less than a specified amount to open or contribute to a Roth. Minimum distributions are required. If you have a traditional IRA, you must begin taking RMDs at the age of 72. RMDs are not required on Roth IRAs during your lifetime. Withdrawals made too soon. You can withdraw your contributions from a Roth IRA at any time, for any reason, with no tax or penalty. Withdrawals after the age of 72 are tax-free and penalty-free, providing the account is at least 5 years old. With traditional IRAs, withdrawals are tax-free after you reach the age of 72. Traditional IRA withdrawals are taxed, so keep that in mind. Whatever kind of a self-directed IRA you have, these restrictions apply. SDIRAs must likewise adhere to the yearly contribution limits that apply to all IRAs. That works out to $6,000 per year in 2021, or $7,000 if you're 50 or older. Putting money into a self-directed IRA. Self-directed Roth IRAs provide access to a vast array of investing options. You can own assets that aren't generally part of a retirement portfolio in addition to the standard investments, stocks, bonds, cash, money market funds, and mutual funds. You can, for example, invest in real estate and hold it in your SDIRA account. Partnerships, tax liens, and even a franchise firm might be held. In self-directed IRAs, whether Roth or regular, the Internal Revenue Service, IRS, prohibits a few specific investments. Life insurance, S-corporation stocks, any investment that constitutes a prohibited transaction, such as one that includes self-dealing, and collectibles, for example, are prohibited. Antiques, artwork, alcoholic drinks, baseball cards, memorabilia, jewelry, stamps, and rare coins are all examples of collectibles. Note that this affects the kind of gold that a self-directed Roth IRA can hold. Consult a financial professional to ensure you aren't breaking any restrictions by accident. SDIRA, Self-Directed Individual Retirement Account, Risks. SDIRAs have numerous advantages. However, there are a few factors to be aware of. Transactions that are prohibited. If you break one of the rules, your entire account may be handed to you. You'll also be responsible for all taxes, as well as a penalty. Make sure you're familiar with and following the regulations for the assets you have in the account. It's important to do your homework. SDIRA custodians, once again, are unable to provide financial advice. You're completely on your own. Make sure you do your homework and seek the advice of a qualified financial advisor if you require assistance. Fees. The fee structure for SDIRAs is convoluted. A one-time setup fee, a first-year annual fee, an annual renewal fee, and fees for paying investment bills are all common expenses. These expenses pile up and might significantly reduce your revenue. Your exit strategy. Stocks, bonds, and mutual funds are simple to get out of. All you have to do is place a sell order with your broker, and the market will handle the rest. This is not the case with some SDIRA investments. If you own an apartment complex, for example, finding the perfect buyer will take some time. If you have a traditional SDIRA and need to start taking distributions, this might be very difficult. Fraud. Despite the fact that SDIRA custodians are unable to provide financial advice, they can make some assets available. SDIRA custodians don't often evaluate the quality or authenticity of any investment in the self-directed IRA or its promoters, according to the Securities and Exchange Commission. To know more, visit factoronline.com site or click the link below.